Welcome to Rebank, your front row seat to the future of finance. Nikhil Raghuveera, welcome to Rebank.
Thanks for having me. Excited to be here.
It's great to connect with you. We've had a bunch of conversations off the record, not behind the microphone. I'm very glad to share some of this with the broader community. I'd love for you to maybe kick off with an intro and tell us what you're working on.
Yeah, so co-founder and CEO of Predicate, we build on-chain policy infrastructure. We essentially allow developers and organizations to be able to set programmatic rules for what transactions can go through their on-chain financial application. There's a lot in that, but a lot of it involves kind of deep technical tooling for more institutional use cases over time. And then my background before this was, I worked at Celo, the layer 2 blockchain now. It used to be a layer 1 blockchain, where I was head of strategy and innovation there. So I actually led most of the major Web3 deployments on the Celo blockchain for some time. And then have also been pretty active in digital asset policy. Was a senior fellow at the Atlantic Council. And then I started my career over a decade ago in economic consulting in the litigation space on securities and antitrust. So, super sexy stuff. And then spent time in management consulting at BCG as well.
I don't know a ton about Celo, but I do think of it as having been focused on some very real world use cases. I wonder if you want to talk about that, because I think it might be relevant context for the conversation we'll have.
There's a few things that really drew me into crypto. One of them was around payments, right? So how do you have much faster, much more seamless payments than what we normally have, especially when it comes to international transfers, as well as operating in markets that don't necessarily have great financial infrastructure. So that was a big interest for me, which is one of the main reasons I ended up at Celo. So yeah, a lot of the work there was and this was, earlier days of when there were no concepts of L2s. It was really just L1s, and it was Ethereum or build a new L1. And so at the time it was, hey, a new L1 is needed that is much better from a payment standpoint. How do you have, gas fees paid for by a stablecoin? How does it work in more mobile friendly architectures where it's not everyone's going to be able to have a computer to be able to do these more normal payments and financial applications? And so we actually had to construct a new L1 for that, kind of an updated consensus model. It was proof of stake rather than proof of work. And yeah, a lot of then is how do you then go to that go-to-market process of getting different things that are built on a blockchain?
Yeah. No, I mean, look, I think it's so relevant because of, in a sense, what we're seeing today. You and I both are kind of focused on the intersection between institutional or real economy or regulated financial use cases and crypto blockchain infrastructure. For me, it's more around asset tokenization, stable coins, and market infrastructure related to the two. Your tooling at Predicate ultimately will support and ensure institutional usability of all of this infrastructure and all these flows that we're building. I mean, it seems like a very unique time in the space. We've, of course, seen a lot of momentum ever since the current presidential administration really took office at the beginning of the year. But that's just continued. There were maybe points in time when it seemed like things could have potentially slowed down. But if anything, it feels right now like things are ramping up. But maybe before we dive into the kind of individual, in a sense, stories or news that have been breaking recently, if you want to step back, just general context, I mean, when did you start this business? And then how do you see its relevance in the market today?
Yeah, so we started Predicate 2 years ago, almost pretty close to exactly 2 years ago in October of 2023. And the core hypothesis, which, Will, I think you probably align to as well, is that blockchains become a global financial settlement system, right? I think that's the view that, it's not just a crypto economy, but rather we're thinking about the entire financial system really operating on blockchains as the next era of finance when we look to the future. And so for us, it was, okay, so great. That's where we start from. And then from there, the question is, okay, cool. So who's operating and existing and transacting on a new global financial settlement system? And then from there that it would be, businesses operating in regulated markets. They exist in regulated markets. They're doing things. They have customers. And then it's users coming in from regulated markets, such as you and I, who are both in the United States. And so if that is the case, that you have businesses operating in regulated markets and users coming in from regulated markets, you need policy infrastructure to actually be able to meet all those different regulatory requirements and business requirements organizations have. And this doesn't mean it's just, securities. It's not that. Securities are a regulated product issued by businesses operating in regulated markets. The same way that a stablecoin is not a security, but a stablecoin is issued by an organization operating in a regulated market, right? A user, if you're in the United States, you can't go and do certain things because it's not allowed in the United States, right? Like some of the betting markets, very clearly not allowed for Americans because that is something that US regulation does not allow for. All of those things are complex policies. And so for us at Predicate, we said someone is going to need to build that infrastructure, or each organization and user is going to have to do their own system. So we said, what if we can build a more generalizable mechanism to be able to build and enforce that? That was really our journey. And obviously, my co-founder was also at Celo with me, and there was always this view that we're building for a new global financial settlement system. So let's think about the rails for that. That's really what led us to this.
Yeah. Interesting. So in my mind, the biggest, maybe the biggest announcement over the past, 2 weeks or so was really the Fed. I think it was Governor Waller effectively referencing work that they're considering to open up access to Fed master accounts, specifically a quote unquote skinny master account, to effectively payments companies, other types of banks which maybe don't currently have access, and among the payments companies, it would be stablecoin issuers. So it seems like certain firms like a Circle, like a Ripple, like a Custodia Bank, others that are very much focused on the digital assets crypto space could soon, sounds like potentially as early as Q1, start to get direct access. And I think even firms like Anchorage and others have maybe been working on this for some time. I remember there was a bit of a saga probably a couple of years ago now. What was the guy's background? I can't remember. Maybe he was actually like coming from the Federal Reserve himself or something, but had basically been applying for a bank charter on a narrow bank model. And in fact, I think that was even the name of the company, the narrow bank. It was not going to do lending. It was not going to be a fractional reserve bank. It was just going to have a master account at the Fed. It was going to deposit all of its reserves directly with the Fed. And it was therefore going to be, in a sense, like impenetrable to runs, and it was going to be the safest possible bank. Mm-hmm. I think some of this blew up post SVB because we saw from a regional banking crisis standpoint, like, okay, if you're not covered on deposits over, say, 250K current FDIC limits, then actually in a digital age where everything's accessible via online banking, let alone in a 24/7 instant, blockchain-powered financial world, a bank run can happen in an instant. So a lot of this kind of comes together and ultimately, I think, creates this really interesting opportunity. Now, it sounds like what Governor Waller was suggesting was more of a focus on payments in these narrow master accounts, skinny master accounts, rather than access to the Fed window or interest on any balances at the Fed or doing other sorts of financial operations, but basically the ability to plug into the FedWire payment system, the ability to directly plug into ACH infrastructure without having to go via other banks, which ultimately means, from a consumer experience, all the payments that we experience in the U.S., at least the vast majority, are slow. They feel archaic from an internet era. But the Fed rails themselves aren't actually so. A lot of throttling actually happens at the commercial bank level in terms of the way they run their operations, and then therefore what they offer out, like the functionality, the rails that they offer out to their clients. So being able to offer to more technically savvy firms that have more of an interest in the instant movement and settlement of money via direct access to the Fed could be transformational. And I think it could ultimately get to a world where you're not necessarily constrained as much by the off-chain to on-chain flows, which are now inherent in minting stablecoins, redeeming stablecoins. But you could actually get to a place where, similar to the way you can in the separate zone in Europe, you can go from a euro in a bank account to a euro stablecoin in your wallet instantly.
Right.
That is just a fundamentally different paradigm than what we have today.
Yep.
And I think would only support the power and the differentiation of the stablecoin based payments experience versus traditional payments.
Yeah, no, I think that's right. When I saw that, I was really thinking about, I think, towards your last point, which is that's like likely something that is more seamless for a user or for a business to say, great, how do I go from fiat to stablecoin as quickly as possible with the capability of Fedwire? I'm also wondering if it pushes more and more banks to then start creating stablecoins themselves, because it's sort of in your benefit to do so, right? Because now you're saying, wait, like we have our own payment, like we're able to extend Fedwire over into a stablecoin based system. And you may not want to be a bank that says, oh, like, there's Circle as an account, but we don't have an account. And so we also need to have, given that we have an account, we also need a stablecoin. I'm very curious to see how that plays out. The other part to me that's interesting is, Fedwire is of course, oftentimes used for payments between financial institutions as well, right? And so the other part that I'm curious on is, how does this link different financial institutions? I think every stablecoin the stablecoin issuers are all going to be banks, right? Like that is really where Genius is taking us to is, it's a bank. They have to meet different reserve requirements. They have BSA that they have to meet, all of those things. It's going to be a bank as the ones who are issuing a stablecoin. I'm really curious what this also means if it continues to push us into a world where stablecoin issuers then also have different costs of capital, lower cost of capital than the average user. That has implications in terms of where are they sourcing capital from for their own balance sheets? And then how much debt do they take on versus how much do they actually need to have on hand? This influences really the capital flow on a blockchain. What I mean by this is, like take right now, if I want to go and get stablecoin liquidity on chain, right? Simplest way I'll do it is probably go to Uniswap, right? Or go to Aave. I'll take ETH. If I'm taking Aave, like I might take ETH and then use that as collateral, borrow USDC. Or I can go on Uniswap, swap my ETH for USDC. All this assumes liquidity on chain, right? But the more and more you get, in my mind, the more and more you have financial institutions with stablecoins that get further meshed into existing financial systems as well, the cost of capital changes as well. Their ability of deploying capital, accessing capital is different. This makes me wonder over time if, the actual liquidity that's being provided is not by you or I, and not by as much by retail. It ends up being more and more by institutions because they have lower cost of capital to supply that in the first place.
That's interesting. I guess a few reactions to that. One, I'd love to go a little bit deeper in how you see Genius impacting the market and this I guess expectation that stablecoin issuers ultimately become banks or vice versa. But I think about a bank having kind of cost of capital considerations because they're running effectively this like NIM business where they're raising liabilities on one side and kind of buying assets / originating them in the form of loans and earning the net interest margin, and they're doing that with a limited effectively equity capital buffer to support the broader business, versus stablecoin issuers as effectively fully collateralized dollars. I guess cost of capital today to Circle and Tether is zero because they're not actually paying anything back through. On the other hand, and I guess this plays into the Fed Reserve accounts conversation. A lot of the balance sheet building would be premised on, I guess like stablecoin is bank. It suggests there's some sort of like long-term durable float that the issuer creates and maintains. Mm-hmm. Whereas I think it'll be interesting to see how the use of stablecoins and therefore I guess even the circulation, the float of stablecoins are geared toward holding value at rest, effectively store of value, versus purely a payment instrument. If you have access to the direct Fed account, right? Someone can basically wire in cash from any bank, mint a stablecoin, use the stablecoin, and potentially redeem the stablecoin back for cash, more or less instantly. And I think, part of the premise of what we're building is that actually a lot of stablecoins can quickly be converted into investment assets, tokenized assets that are maybe paying yield, and that fundamentally play a different role in the sort of financial asset taxonomy. So I think it'll be really interesting to see how things evolve.
Yeah, I actually wanted to ask there, like, how do you see this playing out, especially in the context of, that movement between tokenized assets such as stablecoins over to, real world assets that are tokenized on a blockchain. But I think simultaneously, that access to traditional, investment products that may not be sitting on a blockchain? Do you see that becoming more and more seamless, or do you think it accelerates more and more tokenization of assets on a blockchain? Or do you think it has no effect either way?
One view, strongly held view, every dollar of stablecoins is ultimately a dollar of tokenized assets.
Mm-hmm.
As in, any dollar that's moving on chain will ultimately either be collateralized by a dollar of tokenized assets, risk-free assets, or will be invested for a yield, for a return in tokenized assets. So I think that in a sense, like the acceleration of the stablecoin market equates to an acceleration of the tokenized asset market.
Okay.
Also, I do think that there's a lot of talk, I guess, about 24/7 instant settlement on chain. But that is not the way that the market currently works from a tokenized assets standpoint, and it's because there are a number of friction points. It's because there's missing infrastructure. So, in my view, as we actually deliver more of that kind of instant convertibility / DVP transactability between stablecoins and tokenized assets, we're very quickly going to see a much broader range of tokenized assets come to market. And it's not because there's demand for an asset in token form per se. It's because the flow of being able to instantly move from cash equivalent in the form of a stablecoin, or ultimately tokenized deposit, whichever the way the market ends up going, and an investment product instantly with zero counterparty risk, zero settlement risk. That, I think, is what ultimately will really unlock the demand for investment assets in token form and really unlock the floodgates. And in fact, I think we're going to be surprised sooner or later where things stop being this kind of like one-off packaging and issuance of a single fund or a debt instrument or piece of real property in token form. But you end up going straight to, maybe it ends up being a central depository. Maybe it ends up being some other sort of existing intermediary. I don't know, like large incumbent transfer agent or a fund administrator who basically in one fell swoop tokenizes their entire book in a sense. So I wanted to bring this back around to you and your day-to-day. We're talking about crypto blockchain rails that are increasingly being used in one, real economy, and two, kind of traditional financial settings with permissioned and regulated assets, as you point out. What is the problem space that you see as this intersection evolves? And in a sense, like what have we already identified and are starting to solve for versus potentially what are larger open questions?
I think some of the things that we're solving for today, right, is really just how do you, like the way I frame the development of like kind of blockchain-based systems is you have permissionless blockchains, right? And then you have permissionless DeFi on that. So permissionless blockchain, Ethereum, Solana, permissionless DeFi, Aave, Uniswap. And then you have financial products that are being built on blockchains, right? Great examples of this are things like Morpho Vaults, Uniswap V4 hooks, Plume's Nest yield product, things like that. And so when you do that, or even, another one is like privacy type of applications. So once you go into that, you're saying, okay, great. We are building financial products that exist on blockchains. And the reason why is a lot of the stuff that we just talked about, right? Like 24/7 access, composability, programmability, like all of those facets work in its favor to build a financial product on a blockchain. Once you do that, then the real challenge is great. Like, how do I really think about my compliance requirements for these different things? And you might be, building a system that's supplying yield to users. You might be building, a vault system for tokenized securities. You might be saying, look, like there's a privacy system to be able to make private payments for B2B payments. In all these cases, it opens up a bunch of thorny questions around where are those funds that are about to come into my system, my financial application, where are they coming from? Can it come from a North Korean address? Can it come from a major exploit following something like a Bybit hack? Those are problems, and you have to figure out, like, you don't want those assets to come in. And it's because, again, these are applications that are built on, these are not really, like fully decentralized protocols. These are financial products. So how do you think about programmatically what assets can go in? And this isn't a novel concept. Like this is there in traditional financial systems. It's there in fintech. Even if you were to go use ChatGPT by OpenAI, like there are certain requirements when you try to log in. It's not KYC, KYB, but if someone from North Korea tries to go into ChatGPT, they actually won't be able to. So all these are really pre-transaction rules. And so that's where we're really honing in on is all of these things require complex rules that have to be done before a transaction gets executed. And that's a real challenging part, right? Because transactions on a blockchain just move so much faster than anything in the traditional financial space. And so really, once something happens, like if it's already goes to your system, it's too late oftentimes. How do you prevent certain things from happening in the first place? So for us, we're pretty heavily really in RWA space for a lot of vault types of systems and DEX pools. Mm-hmm. For privacy systems as well, of how do they enforce compliance, especially in the world of privacy, which gets really thorny. And then more and more around stablecoins as well, as how do you, as a stablecoin issuer or a stablecoin platform, really think about the different types of requirements you might need for who can hold or use your asset in the first place.
So, interesting that there were a few other things that that we came across over the past week or two, which I think are, in a sense, interesting to think about in the context of what you just said. So JP Morgan reported in the Wall Street Journal, frankly, the first time I've seen the Wall Street Journal excited about anything related to tokenized assets, but JP Morgan tokenizing one of its private equity funds on its Connexus chain, which is, as far as I know, a private blockchain. JP Morgan seems like could be exactly the type of firm that we were talking about before that could, in one fell swoop, tokenize a broad range of financial products. So they're using a private blockchain. Same time, Securities and Bank of New York announced the issuance or the creation of a CLO that Bank of New York is managing and providing services for, and Securities is doing the issuance and I guess distribution of. That's on public blockchain. But with compliance permissioning, whitelisting, onboarding, KYB, which Securities performs,
yep,
and enforces at the token level, in the same way that virtually all tokenized assets, or at least regulated tokenized assets in public environments are implemented. So, how do you think? JP Morgan's approach is basically we'll run this on private infrastructure. That's how we'll solve for things. Securitized approach is we will enforce this programmatically at the token layer. How do you think about, I guess, those two approaches? What do they solve for? What potential gaps do they, or at least trade-offs do they make? And then as markets really ramp up, like what other considerations should those firms and issuers have?
Yeah, I don't know this for sure, and I haven't looked as deeply on these two specific cases, but generally speaking, in my mind, I don't see the true value of a fully permissioned blockchain other than an institution says, oh, we can more quickly deploy this. It's like a speed of execution that they've already gotten the buy-in, from product engineering, compliance, like leadership. It's like, all right, cool. We built this thing, we can go and deploy it there. Less work, right? Less diligence. So you've done it a few times, you can go and continue doing it there. But from an overarching standpoint, I don't see the true value of a fully permissioned blockchain. Instead, in my mind, the best places to do this is still on a permissionless blockchain. Now, you might have certain architectural implications to this, right? Like Circle has talked about this and why they're doing Arc. You can debate on whether that's needed or if you can do it on Ethereum or on Solana already. But in terms of like doing it on the more public blockchains, it's really just, in my mind, a lot of this is actually possible now, right? And it's proven really well. Like I think Securities is able to say, look, we can actually enforce certain requirements for your token contract. You can do that within your vaults as well. You can do that within different DeFi applications if you want to start opening it up. Same with folks like when you look at Franklin Templeton and Wisdom Tree, like those are their tokenized assets deployed on a public blockchain. Now you can add a ton of gating to it, right? Like I as a user can't just go and pick up a Franklin Templeton Benji token. Like I have to actually create an account with them as a retail user, and then I have to go through their platform. It still exists on a public blockchain. And I think in my mind, it tells you that actually there's a lot that you can already do on public blockchains. You don't need a private blockchain. A private blockchain in my mind is more like, oh, we have the approvals to be able to do it, so we can go do it, versus thinking about any other types of risks or factors you might have to account for when you're deploying, let's say, on Ethereum or Solana. An example of this is, I would imagine that JP Morgan deploying this asset on their own chain, they don't have to worry about, wait, so was there just a major exploit on Ethereum that now funds are going through? What is our risk to this? Is this at all about to touch us? But if it's on JP Morgan, you just say, like, we don't even have to think about it. You have to have that extra question, and then it's a question of, did we put in the adequate controls on Ethereum? Which you can do. It's just potentially less that you have to think about.
What are some examples of the, I guess, problems that you're solving today for your clients? And then, related to that, where are you seeing the most traction?
Yeah, sure. So we started touching on this a little bit, but some of the use cases that we have that we're solving for. So I'll give you a few like explicit examples. So one of them is Plume. So their entire, they have a product called Nest, which is a vault-based system that supplies yield to users. And so we power their compliance infrastructure. So anytime someone is depositing into Nest to earn yield from tokenized treasuries, public credit, private credit, Predicate is doing a check on the back end to ensure that assets are not coming from high-risk locations. So it's not just sanctions. It's, other categories like terrorist financing, human trafficking, major exploits, those kinds of things. So we essentially provide that enforcement mechanism at a smart contract level for Plume. So a user can't bypass it. They have to go through a predicate check in order to do it. And again, to note, it's not KYC, right? They're not having a KYC. There's no change to the user experience. It's just requirements that they don't realize are being met, but it's being met. So that's one. Another one is some of the work in the privacy space. So take someone like Aleo, privacy blockchain, right? Something that is like very difficult to tackle. How do you have true privacy? And so for them, because it's a privacy blockchain, they have to, from an ecosystem standpoint, they wanted to ensure that high-risk assets can't enter into their privacy system. They don't want it to be like a tornado cash or something like that. They want it to be very clearly, look, like we are building a robust L1 blockchain with clean liquidity. And when I say they, I mean the Aleo ecosystem. So they passed a governance proposal saying that all token bridges need to have certain risk management requirements that they're enforcing in order to be a bridge. And so those bridges use Predicate to say, look, certain assets cannot be bridged from Ethereum or BSC or Arbitrum over to the Aleo blockchain. So that's like another use case that we have. So those are two examples. Now, where are we getting kind of the most usage right now and traction? I would say it's in those DeFi, like the DeFi interfacing with institutional yield types of things. So like a Plume, so that vertical within like DeFi yield. I would say similarly, we've been doing a lot of work on the DEX side. So we have a paper with Paxos and Uniswap around institutional DEX pools. So that's another vertical. We've done a lot of work, obviously, on privacy. So we have a number of privacy projects that we work with. Aztec and Maiden, for example, are two others. And Seismic is another one we started working with. And then on the stablecoin side, so we work with Paxos, Paxos Labs, M0, and a number of others that we haven't announced yet. But that's another big vertical for us where we're spending a lot more time and just getting a lot more folks asking us questions about it.
That totally makes sense. So it sounds like the biggest areas of traction for the moment are around basically permissionless use cases, but where either the issuer or the infrastructure provider or potentially the institutional capital provider into a permissionless ecosystem wants to ensure some level of maybe primarily sanctions screening.
It's usually not just sanctions, because sanctions is really easy, right? So sanctions is just a static list. But the thing is with sanctions, it doesn't really do much. So what I would do if I'm a sanctioned entity is I will be on a sanctions list and I will immediately move my funds from that sanctioned address to another address. I'm no longer sanctioned. That's it, right? Like I'm not on a sanctions list anymore. That's the fundamental problem when we think of crypto and we say, oh, you're just checking for sanctions. That is the easiest bar to possibly pass. It doesn't work at all. And some of our partners have seen that, where we've blocked transactions that are associated to sanctioned addresses, but not directly to the sanctioned address. No sanctioned address actually holds the funds in their wallet. There's no reason to. It's completely illogical to do it when it's so easy to move it.
So it's a more comprehensive approach to basically identify, I mean, at the end of the day, like money launderers or illicit actors, right? That you don't want to be interacting with, even if you're a permissionless protocol or platform.
Yeah. I mean, I would say in our case too, like the folks who are using us have some points of centralization. Again, this is why I was drawing a distinction between a decentralized, like a DeFi protocol and an application, right? So I would never say that Predicate should be used for all of like the Uniswap v3. Uniswap is a permissionless DeFi protocol. Uniswap v4, though, is hooks, right? And so different types of hooks will have different requirements. Whether that is, a Paxos using a V4 hook or an M0 using a V4 hook or someone else, these are applications. And so that's really where we're honing in on. And that distinction is really important, especially from a permissionless nature and composability. Because if you put something like Predicate and have a set of requirements on Uniswap v3, everyone is stuck with that, right? It doesn't even matter from a V4 standpoint. But in our case, it's much more around that expressivity.
Zooming out, what's your path to like 100x growth from here? Like what would you like to see in the market?
Yeah, I think for us, it's really our vision is that, more and more large organizations, fintechs, and financial institutions are actually going to be deploying on-chain financial products. I will say, like, as much as you have all these different announcements and things like that, they're not truly on-chain, or there's very much like a full gated system that's off, right? It's not interacting as much. I think the biggest push has recently been on stablecoins. That has been perhaps the one item that you're seeing a lot more activity. But I'd say most of the tokenized securities in the past have really just been, like they're fully walled gardens. Like they're not really trying to deal with the composability and openness of blockchains and the global access of that. So for us, where the growth really picks up is when you have larger organizations, fintechs, and financial institutions saying, wait, we're creating on-chain financial products here that actually go into, leverage smart contracts deeply. It's that interoperability. It's that flow between fully permissionless markets into more regulated settings. It's all these different categories there. And I think as more and more of those regulated activities come on chain, that's great for us. That's really where we're seeing the world go. And I think that's really, again, it harkens back to the original view, which is that blockchains have become a global financial settlement system. And it's a global financial settlement system, right? So it's not just for a small set of institutions or a small set of users. It is for people all around the world and organizations all around the world. When that happens, you're moving capital across all these different settings, across different markets, across permissionless and permission settings. You
expect to ultimately be that connective tissue, which will enable the on-chain Venmo.
That's our vision.
Move funds from the US to Europe.
That's right. I would say like we're not going to build the front end Venmo for the payments itself, but let's say that compliance infrastructure for that would be us. Like that's really our goal.
Amazing. Wonderful vision and crucial tooling for the growth of this space.
Yeah, no, I appreciate it. It's definitely been a journey. I would say 2 years ago was more of a hot take, and I think now we're seeing a little bit more of, okay, cool. Like there's more businesses and large organizations that are coming on chain.
Nikhil, any closing thoughts before we wrap up?
I'm always fascinated to see like where things go in the next 6 months. Like even now it's end of October. So here's to see what happens between now and the end of the year. There's obviously been a government shutdown in the US. So that's also changed the dynamic of things of what might happen and how quickly will certain things happen versus then we get into an election period. So for me, I'm actually really curious on what happens in the world over the next 6 months. I think a lot will happen.
Great. Well, thank you very much for your time today. Great to speak with you.
Yeah, appreciate it. Thanks, Will.